How does swing trading work? Swing trading is a trading strategy that aims to capitalize on the price movements of stocks over a short to medium-term period. Unlike day trading, swing traders hold positions for a few days to weeks, taking advantage of momentum and potential reversals in the market. What is swing trading? Swing trading involves holding assets for a duration longer than a single day, typically for a few days to a few weeks. This approach is popular in the stock market and focuses on capturing gains within that time frame. Swing traders use various tactics to identify potential opportunities and take advantage of them. The concept behind swing trading is based on the idea that after a significant price movement, there may be a high likelihood of a reversal, similar to a stretched rubber band snapping back. The objective of swing trading is to profit from short to medium-term priced swings in the market. Swing traders typically hold their positions overnight or for several days. Risk management is crucial in swing trading, with the use of stop-loss orders to limit losses and ensure quick exits when necessary. How does swing trading work? Swing traders look for assets with high volume and volatility, as these provide potential opportunities for price movement. They analyze charts and indicators such as Relative Strength Index, RSI, Moving Average Convergence Divergence, MACD, volume, and trend lines to understand historical performance and predict future trends. Setting up an entry involves placing a stop-loss order below the entry price and setting a target price above the entry price. Swing traders take advantage of price movements by buying at support levels and selling at resistance levels. Swing trading methods. Swing traders often engage in multiple smaller trades to achieve their desired position size. They use techniques such as technical analysis, fundamental analysis, and charting to profit from fluctuations in asset prices. Trend following and mean reversion are common strategies employed by swing traders, along with the use of moving averages to determine price direction. Opportunities for swing traders. Swing traders have numerous opportunities within a trend, but it's important to consider factors like taxes and commissions that can impact profitability. By analyzing price charts and identifying swing highs and lows, swing traders can forecast price direction accurately. Positions are typically closed within 3 to 4 weeks, making swing trading suitable for those looking for short to medium-term trades. Advantages and disadvantages of swing trading. Swing trading offers several advantages, including the ability to capture profits quickly, adjust positions swiftly, and utilize both long and short-term strategies. It provides flexibility and requires less time compared to day trading. However, swing trading requires a good understanding of financial markets and may result in losses due to false signals and missed long-term opportunities. Overnight and weekend market risks are also factors to consider. Conclusion. Swing trading is a popular trading strategy that involves holding positions for a few days to weeks. It offers leverage and returns but comes with risks. Traders should understand the intricacies of swing trading to avoid potential losses. With proper analysis and risk management, swing trading can be a profitable approach to trading.